So we're getting a lot of questions around inflation and its net impact on the market, and quite frankly, how we would handle it from a portfolio perspective. So we're going to dive into it. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. So as always, before I jump in, quick update on the market. So again, trend lines are holding up. Everything looks good. We did get that bounce off support. We are now above the 20, 50, 200-day moving averages, so everything looks good there. The only concern I'm seeing at this point is a bit of a negative divergence here. So you're seeing the RSI make lower lows, and you're seeing the MACD make lower lows. However, you're seeing the S&P 500 making breaking out to potentially all-time higher highs. So we've got our eye on that, but at the end of the day, we're really just looking for the weight of the evidence to kind of determine are we going up or are we going down. But really, we want to pay attention to these long-term trend lines. Now, to that, there's also, we look at breadth. Breadth is one of the indicators we look at, and we are seeing it as well as a negative divergence on the number of companies that are actually participating in the growth of the S&P 500. So that's starting to fall. The 200-day moving average is more neutral, and the market's going up. So again, just another thing we want to make sure that this line is held, and we want to be watching our trends very closely. And then lastly, before we move on to inflation, just want to get a quick check on the Treasury yield. So we've got a potential head and shoulders here. So we're watching these levels. Obviously, if this support line holds and it comes all the way back up here, the Treasury yield, and completes this potential head and shoulders formation, then again you could expect more pressure on the price of bonds. So we're watching that as well. So this is a good chart that I'm not going to go into all the details. You can read it, but where we're at right now is we are mid to late cycle. So we've definitely seen some greed out there. I don't know if we've gotten to extreme euphoria at this point. And I don't think there's been a blow-off, just kind of finale at this point. So we're watching this economic cycle very closely. But essentially, when you get rising inflation, it does signal a late cycle. So, at that point, you really want to focus on value over growth. You want companies that are actually making money, not those that are potentially poised to make money. So if the Fed funds rise and liquidity is stripped out of the market, the valuations on some of these growth players isn't going to be as attractive in a rising inflationary environment. So, oftentimes when you get rising inflation, then you also have a weak dollar, and that tends to benefit commodities, such as gold. And so again, when we're late cycle, the Fed is raising rates. They're tapering their bond purchases, if not eliminating them. And generally speaking, that's not a very good sign for the market. The market's become very addicted to easy money. But at the end of the day, we want to just make sure that the trend lines are holding up. If not, we go into protection mode and we raise cash and potentially put some shorts on. So in wrapping up, if inflation does come, or should I say when inflation comes, hopefully that gives you a kind of an idea of what we would look for and how we would tackle it. But if you have any questions, or if I can be of assistance to you in any way, give me a shout. My name is Brian Cannon, and we'll see you on the next Markets in 5.